September is the worst month of the year for stocks. And if you believe you should sell because of that, I need you to do me a favor. I need you to take your checkbook. I need you to write yourself a check. Go hand it to your spouse. Let them cash it all out and either piss it away on something like purses or go flush it down the toilet because you should not have any money. This is absolute baloney. Guys, there are 12 months in the year. There will be a month that trails and there will be a month that's best. It doesn't mean you change your investing philosophy because of it. Look at this absolute clickbait on CNN. Here's another potentially ominous sign. This is a midterm election year. The Dow has fallen in 11 of the last 18 pre-midterm Septembers going back to 1950. Oh my God, 11 of 18? So not only would I not believe this if it was 18 out of 18, I would not care, but 11 out of 18? 50% is 9 out of 18. It's either going to go up or down, and 11 out of 18 times it went down. Big whoop. Then people talk about how September is a month of crashes. Guys, the only crash I remember, the only major crash I remember is the financial crisis crash that happened in September of 2007. 1929 crash, that was in October. 1987 crash, that was in October. The 2000 crash for the NASDAQ started in March. I'm not understanding this at all. Even 9/11 that was in September, the market had already fallen since March of 2000, a year and a half earlier before it had that crash. So I can't even sit there and say that crash occurred. Guys, this is absolute baloney and horse. Horse! You cannot listen to this stuff. The whole point of investing is to have a fundamental process for why you're in investments. If you believe that the alignment of the moons or the month of the year is going to affect stocks, you are absolutely delusional. It just happens to be by chance. I'm sure there are 1,000 things we can find that will tell you, like the NFC versus AFC, who wins the Super Bowl ends up determining what's going to happen. It's absolute horse crap. Now, does that mean that there aren't things that fundamentally show the future? Absolutely. Cash flow. Things that matter. Think about something. What does it matter that September would be the worst month of the year or some other month be the best month of the year? What does it have to do with anything? But if you go look, for example, at stocks in the long run and how well they do, it's based on paying a low price versus cash flow and having a good balance sheet. Those things have mattered. And any way you cut it, when you go back and look at those parameters and how they do in stocks, if you focus on those companies, you will do very well. But the fact of you're trying to find data to fit what makes sense, that's absolute horse crap. That is selling snake oil out there in the 1800s. There is no difference. There are 12 months in the year. There will be a month that does the worst, and there will be a month that does the best. Does that mean you should buy and sell in those months? Give me a break. There's no reason why that would work in the future. However, paying a reasonable price for cash flow and balance sheet and other fundamental parameters does make sense, correct? It makes sense to say, I'm going to pay less money for a future stream of cash flow than more money. Because when you have an investment, how do you determine the return? Every investment is the present value of all future cash flow. So your goal should be to pay as little as possible for solid cash flow. What you need to do is learn about the fundamentals of a business and how you buy based on the fundamentals. That is why we use our 8-pillar process on our software. Yes, it can be hard, but I'm telling you right now, the more you learn, the less you fear. If you understand the fundamentals of a company, if you understand what makes up a company and how you might be overpaying for a company, but understand that the rest of it's good, it's about being patient. That's all it's about doing right now. That is what I'm trying to do with my money, and that's what I'm trying to teach. Everybody's going to have their own process. But if your process is driven by these voodoo things based on the alignment of the stars and the skies and all this stuff, and what month of the year, just go spend your money on fun stuff, because you're going to lose your money that way, or you can lose your money by making stupid decisions like this. So my goal here is to teach a process. And if you've already stayed on this video this long, it's appealing to you in some fashion. I'm Paul. I'm a value investor. My goal is to separate price and value. And my goal is to buy when the price is below the value. Now, what does that mean? It tends to mean investing when things look dire, when things aren't good. But that's what works. If you go back in time, all those crashes that I mentioned, 1928, 1987, 9/11, March of 2000, September of 2007, if you'd bought along the way down, you'd be so much wealthier now and you'd been so happy you did it. But in the moment, it is very, very difficult. That is what makes investing hard. It's not the numbers. The numbers are the easy part. I can teach you in a matter of probably an hour how to look at good fundamental businesses. But what I'm trying to do here is teach over and over this process and mindset. The more and more you buy into it, the more and more you agree with it, the more and more you understand it, you will be invincible. 15, 20 years ago, I was the average person. I was emotional on bad days. I was like, oh my God, stocks are going to zero. Now I laugh at that thought. I actually enjoy the idea of stocks falling. If you follow my Instagram or you see my Instagram, there are actually pictures of me in the COVID crash kissing this computer screen and the TV screen with the big red days. I was enjoying it so much. It wasn't fake. It was literally pure enjoyment. I love stocks going down because I love buying things that I love at cheaper prices. And it's easier, by the way, to buy when the entire market is down. Why? Because the market isn't going to zero. So start with that. Start with the process of learning to buy the entire market and stick with it. And that's like I did 15, 20 years ago, 100% of my money, 80% of my money actually was in ETFs. Why? Because the market isn't going anywhere. Then I dabbled in individual stocks. And over time, I got confident enough buying individual stocks that now, whenever I'm invested, it's always in individual stocks. I make my own ETF. That is my goal. This process works. Warren Buffett, Charlie Munger, Seth Klarman, Howard Marks, all these investors learn from the same people, and they all do very well. But they'll tell you, IQ doesn't make you a good investor. Emotional IQ makes you a good investor. Emotional IQ makes you a great investor. And that's our goal here as a company. That's our goal here as a channel. We're trying to teach the emotional aspect, the psychological aspect of investing. Because if you own that and you only buy ETFs, which is super easy to do, you will crush everyone's returns, including and especially the professional money managers who all sit there and charge huge fees to do terrible work. Because over a 15 plus period of time, less than 10% of actively managed large cap funds will even beat the market. Last time I saw, it was 8%, which actually surprised me. I thought it'd be lower than that. If what I'm saying makes sense to you, I need you to do two simple things for me. One, subscribe to this channel, and two, watch our next video on a recessions are opportunities of a lifetime. Thank you very much for your time.